as you go through your journey as a trader, these are really important to come back to. And we found after mentoring, thousands of traders, that these are really the most important concepts, whether you're a day trader, swing trader, position trader. This is kind of universal for all types of trading and really essential for success.
We broke it down into the 4 stages.
Here's a list of some of them: system hopping, FOMO, oversizing, buying extended, buying late. This is an issue I had early on. Overtrading, too many indicators, randomness, lack of risk management, overconfidence, no sell rules, underconfidence, no post analysis. All right, so before we get into it, this webinar will probably be about an hour and a half is what I'm shooting for. We'll see how it actually goes, but I definitely want to leave some time for questions at the end. But as we go through, please drop any questions you have in the Q&A section. As I mentioned, that keeps just everything organized, and that would just help me out immensely. So first things first, as I mentioned, for people who joined, this is the first of 12 webinars that we're doing as a part of the launch of the Trader's Handbook. This is our debut book that we're launching on May 27th. I'm super excited to be putting it out there, and we'll dive into the details about what this covers later on in the video. Down here, you can scan this QR code to pre-order the book and also join the interest list. And we've got a lot of bonuses, which I'll get into, that when you sign up for this list, we'll be sending you educational articles, you'll be eligible for special giveaways, and also exclusive webinars as well. So let's dive in here. So yeah, here's the QR code, just nice and big to hopefully make it easy for you. Again, we've got a lot of special bonuses there. If you join, you'll be eligible for everything. And, I think a lot of the bonus articles add a lot to the book experience, and hopefully you guys find incredibly useful. So here's a little bit about the bonuses that you get once you join the handbook waitlist, and I'll bring up the QR code again in just a second. We already sent the model book chapter preview. Chapter 12 of the Trader's Handbook is basically covering 100 plus model book stocks from recent history, the past 10 years or so, really focusing on recent years as well, and includes charts, annotations, all of that. And we sent a preview as the first kind of key bonus for joining the Trader's Handbook waitlist. And last week we sent an article on the 3 opportunity zones, really where you want to be focused as a trader to be a part of, momentum moves. If you sign up for the waitlist, we get this question a lot. You'll also receive these previous 2 that we sent. So don't feel like you've missed anything, but make sure you sign up so you get today's article on common trading problems, which really goes hand in hand with today's webinar. Then we've got some other educational articles and resources planned to send out to this list. Finding your why, extremely important. It's not all about just making money. It's really important to define for yourself, why are you involved with trading? What are your goals? What are your expectations? That really kind of creates clarity that helps and makes this whole process that much easier. Then we've got some reference sheets on reading price action, edges and setups, entry tactics, stop loss setting reference sheet. We get a lot of questions about how to place stop losses. Where should you put them? This will help with that immensely. Then we've also got a sell rules checklist, because similarly, we get a lot of questions for that. Then we've got another sneak preview of the Market Cycles model book that is a bonus for people who register and pre-order. So definitely be on the lookout for that. Then we've got another one planned on the Tigers framework, basically defining some key criteria to look for as you're scanning stocks and looking for the next great opportunities. And then we've got a trade analytics log. We get a lot of questions about this. How can we calculate our batting average, average gain, average loss? This will do it for you as long as you enter your trades. And then finally, we've got a trade analysis checklist, which is about analyzing a single trade and what you should look for and consider as you're looking to, gain meaningful insight from reviewing your past trades and how to do that. So basically, all in all, join the Trader's Handbook waitlist for webinars, educational articles, sneak previews, giveaways. You guys will be the first to know if you're on the list about all these other resources. And here is the QR code again to join. I'll just pause here a moment to make sure everybody's got a chance to join that waitlist if you're not already on it. All right. Let's see here if there's any key questions. Are recordings going to be available for all webinars? Yes, they will, and we'll send it out first to people on this waitlist. Alan says joined and pre-ordered. Thank you so much. We're super excited to get this out today. We'll get this out on the May 27th, but for you guys to join today, that'd be awesome. All right. Yeah, very cool to see people ordering. Thank you so much. I think you guys will really, really love it. We spent a year plus building, and it incorporates all of our knowledge, all the knowledge of the people who I've interviewed, and really kind of sums everything up. And we'll get into the details later on in the video. The book is 500 pages, 12 chapters. All right. We don't have plans for an audio version just yet, but let me know in the chat. Would you prefer we hire an outside actor, voice actor to record it, or would you prefer one of us to record and present it? We're kind of trying to decide what would be best. Use AI. I don't think so. Megan Fox. Very funny. All right. All right, perfect. A lot of love for the audio. Okay. Yeah, we'll definitely work on that. Okay. So let's continue on here. We've got a lot to cover today. Today's webinar, welcome everybody, is focused on chapter 1 and 2 of the Trader's Handbook, where we'll be discussing the 5 key trading principles to keep in mind, as you're designing your system, as you're going through the progression and the trader's journey. Then we'll dive into common trading problems and the 4 stages of trading. This is kind of high-level material, but it's really essential to build the foundation that we'll, build upon in all of the future 12 webinars where we really get into the details. I promise you, we're going to get into specific entry tactics, where to buy, where to sell, how to manage risk, all of that with a lot of examples as well. But today's webinar is really essential to make sure we're all on the same page, approaching things the same way. And I think we can hopefully solve some common trading problems that you guys are maybe experiencing. And I think it's really important, the 4 stages of trading. This is maybe the most important concept of the book. And the reason being is because it's all about identifying where you are on your trader's journey, and we give kind of a practical framework in the handbook as well as today, how to progress from that point, continue on, improve your performance, improve your system, all of that. So hopefully you guys are super excited about this, and thank you guys all for joining. And let's go ahead and dive right in. All right. So we're going to start with the 5 key principles of trading. And these are very high level and they may seem simple, but simple is powerful, especially when it comes to, managing complex systems. And keep it simple is actually the first one. So both these key principles are simple, but also this is really important as well. So first and foremost, the 5 key principles are: 1, keep it simple; 2, stay focused; 3, plan for failure. And that kind of goes in hand with number 4, manage risk tightly. And then 5, think in cycles. And we'll dive deep into each of these 5 here today. And I think as you go through your journey as a trader, build your system, all of that, these are really important to come back to. And we found after mentoring, thousands of traders, that these are really the most important concepts, whether you're a day trader, swing trader, position trader, whether you trade earnings gaps or pullbacks or mean reversion trades. This is kind of universal for all types of trading and really essential for success, and not just success today, but also continuous improvement and always kind of refining things and getting better over time, because that's the goal. We don't want to become stagnant. The market adapts and evolves, and we need to evolve with it. And these are kind of tried and true principles that will help you do that as you go through your journey. All right. So first things first, keep it simple. I come from an engineering background. Rye also comes from an engineering background, electrical engineering for him, mechanical engineering for me. And in our training, we design complex systems, heat exchangers, generation, all these different type of stuff. But when it comes down to it, the best systems and the most robust systems, meaning you can, weather storms, you can deal with a lot. The best systems are simple. And that's because there's less cogs in the chain to, get kinks, to fail, all of that. It's easier to identify weaknesses and strengths as well. And simplicity overall just leads to stronger performance and robustness. There's a lot of thoughts in the AI space about, overtraining and overtuning models. If you try to design a system about the best moving average to use, if you train it on NVIDIA, it will come up with 17 EMA. If you train it on Tesla, it'll be the 18.5 EMA. Really what we want to do is not try to overtrain and overtune our models, but think of something that, applies universally to all the stocks we trade and all the situations we'll experience. And simplicity is really the key to achieving that robustness that we're looking for. Along with keeping it simple is basically prioritize price action. I think a lot of traders, when they start learning to trade, get obsessed with indicators, MACDs, RSIs, and finding the perfect, magic signal that means they'll always have a winning trade. It's not that simple, and that doesn't work over time. Really, keeping it simple means to focus on what's really important, the root causes of supply and demand, and basically price action is the main way that we analyze that. So focus on price movement first, and using only a few essential indicators that do add value. I personally do use indicators, and we'll get into the ones that I recommend and we recommend at TraderLion later on, but we keep it very minimal. And we always remember that price action rules all. A 21 EMA, even if it's shown respect in the past, doesn't mean it'll show respect in the future. And it's all about identifying character changes around those indicators and making sure they add something to your process. The next bullet here, be precise with rules. This also goes along with simplicity. Clarity in rules and keeping those simple helps with consistency and execution. You don't want to create a rule set that is overly complex and, again, is too specific and overtrained, but you want to have very clear rules that are easy to follow, easy to remember, so that you can actually, apply them in your real trading. So this is really important. And in the chat, I'll actually ask this question later on, but in the chat, let me know if you guys actually have a set of trading rules that you use currently, because we'll address that later on, but I just want to see a sneak preview about your guys' responses. And if you haven't yet, my homework for you is to actually write your first trading rule set this weekend. All right, I see some starting. I see they need work, a lot of work. Well, if you've got it started, refine it. I see some yeses as well, which is awesome. Perfect. All right, very cool to see. All right, make routines easy to follow. Just like your rules, you want to make sure that the routines that you follow, whether it's for finding new ideas or in the market when you're preparing for the trading day, you also want to make sure that those are pretty simple and are just kind of bare bones. They're back down to the core specifics, the core things that you need to do to be successful. And the reason being is probably you guys have outlined a perfect routine where you do 20 different things, analyze, post analysis every single day, all of that. But then, you lack that consistency. You're unable to repeat that on a daily basis, and bring it down to, the key 5 things that you need to be successful. Again, just makes it that much easier to follow. And the best routines are one that you can do consistently and repeatably. And those are the ones that you'll find success with over time. And lastly, to kind of summarize it up, avoid unnecessary complexity. Like we said, complexity creates randomness and confusion. Keep trading as simple as possible. I think a lot of, as we'll get to, the common trading issues come from actually a lack of clarity, increased complexity that adds confusion to what you're doing. You're unable to kind of follow your rules because you're not quite sure what they are. And that kind of increases the emotions that we naturally feel as traders. But if we don't have a simple system, we're unable to adapt and manage those emotions properly. All right. The second key principle of trading is to stay focused. What this means is to master one trading style, whether it's day trading, swing trading, position trading, or investing. Choose one and specialize. There's a common saying in trading, specialists get paid, and that comes with choosing a style, that comes with choosing a setup, and narrowing your focus really allows you to become an expert in that field, in that style. You really basically want to get a PhD in your specific method in the market. Not everybody's going to be the same. Some people are going to be kind of in between swing trading and position trading. I actually kind of put myself in that boat. But basically what you want to do is master processes and setups that apply specifically to how you like to trade the markets and approach the markets. You're not going to be the best day trader as well as investor. It's really hard to focus on all the things that you need to be amazing at both of those. Just think about it. Day trading is all about capturing quick moves, dealing with news catalysts, events like that, while investing is a completely different approach. It's about analyzing fundamentals and reading income statements and all that. Completely different, tool sets. And if you're going to try to become the day trader, it's very hard to do that while you're already also trying to research companies and invest a lot of time into becoming a great investor. So it's much easier to become rich by specializing one of these than try to master all styles and actually at the end of the day, master none of them because you're focusing on too much. The second thing here is focus on a few stocks and setups. This is personally an epiphany that I had a few years ago. I would create a weekly watch list of about 15 stocks, and then at the open I would try to focus on all of them all at once, set alerts on all of them, try to always capture the breakout that's happening from that list, looking at all the different symbols. And what I realized is I would miss more stuff because I'm trying to focus and capture more trades. And a big turning point in my performance and how I approached the market was, instead of focusing on 15 stocks at the open, I narrowed it down every single day to about 3, and ideally 1 or 2. And it might be counterintuitive, but I actually caught more of the best breakouts because I was focusing on less and was able to execute, manage risk better, and overall just become a better trader by focusing on less opportunities, and just trying to get the most out of those that I could possibly do it. So let me know in the chat as well. Do you relate to that story? I think it's a great lesson and something to try as well. Maybe you are now focusing on 10 stocks at the open, 15 stocks. Try out, focusing only on 1 and 2. Obviously, there's going to be ones that you miss where, maybe the 2 stocks that you focus on aren't the ones that break out, and that's part of trading. But then you can always go back and re-examine your process and see, why wasn't this stock that broke out on my daily focus list of the 2 stocks? Think about whether, you were looking at the proper price action patterns, whatever it was. Maybe you missed something in your process, and then you can go and improve your system, as we've talked about. All right, the next bullet here, use strict selection criteria. This is important as well. Just like you want to narrow your focus on a daily basis, when you're actually building your focus list, you want to focus on only the best stocks for your style, for your time frame. You don't want to be trying to trade everything using a Cancelim framework, or you don't want to be trying to trade everything using a day trading framework. You want to focus and specialize on the stocks that are most ready and most eligible for those type of styles and systems. So you really want to use something like DeepView to screen out the majority of the market, really 95% or not even 99%, and focus only on the best stocks that are set up for your system and for your style. And I mentioned this, earlier. You want to develop expertise through specialization, become a PhD, an expert in your field, in your specific style, because you only need one style to become extremely wealthy in the stock market. But you do have to pick that one style and dedicate, years and years to mastering it. And, there's never actually mastery in trading. You're always consistently improving, but you want to specialize so you just get as good as you can be in that particular style. And what's great about that specialization is actually it brings confidence. It brings, it brings a well thought out system to the markets. And this confidence is huge in trading. The best traders are confident in their abilities. Even in poor markets, they know they can either step aside or adapt to them. And having this specialization and becoming the best day trader or swing trader allows you to be very confident that you can perform during the best market conditions, make the performance goals that you need to achieve your goals, and just be able to weather anything. But without being focused on one style, you'll kind of be an unconfident trader, both day trading, swing trading, or position trading, and aren't able to build that confidence over time because you're trying to focus on so much and master everything all at once, versus just kind of specializing on one single area, becoming a scalpel versus a multi-tool, a Swiss Army tool. So I think this is really important, is all of this focus builds confidence. And if you're somebody who hesitates at the open, hesitates with trade execution, maybe you're trying to focus on too much right now, and think about what you can cut out and improve over time. All right, this is a really important one, plan for failure. And again, I think traders come into the trading arena, they get excited, they make their first trade, and they have unrealistic expectations. They see trades that are on social media, that are in the news about people making $1 billion, people making 1,000% in a year, and they think they can go out and do that right away. When the reality is, just like getting a PhD, it takes an undergraduate degree, it takes a master's program, and then it takes even further research to specialize in that very specific area to get your PhD and defend your thesis. So that takes time. That takes about 6, 7, some people even 8 years to get a PhD. And it's kind of similar for trading. Looking back, we've studied some of the best traders. We also did the historical analysis masterclass with John Boyk, which shout out to John. He's fantastic. And if there are any students in here who took that class, let me know as well. But he studied basically the best traders going back in history: Richard Wyckoff, William O'Neill, those type of legends. And even them took about 6 years on average to figure out their system, become profitable, and really kind of figure out what they're doing. And none of them, stop learning. They all continuously work to improve, build new edges, all of that. And that's a big part about being a trader who lasts and is trading for decades, which is, of course, our goal to really compound over time. So I think what I'm trying to say here is you want to set realistic expectations about how long this will take to actually, achieve some level of mastery. It doesn't mean you can't perform earlier, but it is going to take, about 5 years to really feel comfortable, feel confident, and act with confidence in your system. And we've got Rye here joining us. How's it going, Rye?
Yeah, that's my bad. Just trying to get my
He's
Wi-Fi and all
Yeah,
working.
he's traveling right now, so it's good to have his perspective as well. But I think what it really comes down to is to build a system over time. Um, it does take going through multiple full bear market, bull and bear market cycles to kind of understand how corrections begin, what bottoming action looks like, how to find new leaders, and kind of build that system over time and learn a new thing with every correction you experience. So it might not take exactly 6 years, and hopefully if you're watching this webinar, we can speed up your learning curve quite a bit, but do have an expectation that it might take some time to really build a system that you're extremely proud of and comfortable with and can excel with. Then the second point here, protect your capital. Part of planning for failure is understanding that most trades will end in losses, but the key is to keep those relatively small to your gains and build resilience into your system, robustness by, planning for failure, expecting, a batting average about 50% in the best markets. If you're William O'Neill, maybe that's 60%, but, understand that your edge is really in managing your risk and keeping your losses small versus being right all the time. Now, this does depend on your trading time frame. Day traders, their edge is more on, having a higher batting average, but for swing traders, position traders, our edge is more in establishing asymmetry and making sure that we're letting our winners run and keeping our losses as small as can be. Part of this as well is expecting rough market conditions. Let me know in the chat here, how you've dealt with this year so far, because it has been relatively difficult. We had a choppy period where we had a lot of gap ups and gap downs due to news catalysts, and then recently we've seen a pretty significant and sharp pullback in the market. So these type of markets happen. It's not always going to be a strong uptrend like we saw in the fall of last year. But you want to build in resiliency into your system so you can deal with these different changing market conditions and be able to analyze them and realize that change in the moment, so you can adjust and take the proper actions. And this gets into build resiliency. As I mentioned, your trading system and mindset must be strong enough to deal with these changes, endure losing streaks, which are going to happen, and overall market volatility. And lastly, all this market volatility and hardship that you're going to experience builds your character. Again, it builds your confidence. If you survive a correction and only experience a 7% pullback in your account or 5% pullback in your account, that should give you, a boost of confidence and say, now when the market turns around, I can basically benefit starting from even versus down a bunch of percent, and I'm ready to capitalize on the next opportunity. So all this failure should build confidence in yourself, and that will help you not only in trading, but also in life as well. You'll be able to deal with hardships that we all experience, relationship-wise, financial-wise, work-wise, professional-wise, whatever it may be. So this lesson, plan for failure, applies not just to the markets and trading, but also your entire life. And Rye, I don't know if you want to add anything here or kind of start from any of the key principles that we talked about, but yeah, feel free to add your piece.
Yeah, I think as you go through, and it's all about, it's going to take some time. It will be a journey. You'll have losing years, which will make you a lot better than instant success and never seeing failure in the markets. And that's really, one of the quotes that I posted from David Ryan yesterday was, he's like, the best learning is in your losing trades. The more often you look at those, the better you will be. And that's a consistent message that we've seen across all market visits, any interview that Richard's doing. right? One, you want to protect your capital. Two, you want to take your losses quickly. Three is use failure as fuel instead of, taking it as something that, many people give up on because that's the only thing that they see in, in the first 5 or 6 years when they're trading the market. So take your losses quickly. Expect, it's not going to be a fun ride. If it was, I think everybody would be doing it, right? And everybody will be working from home trading the markets. It's not like that. It's a profession that's much tougher, but much more rewarding when once you figure it out. So I think that's a really key point. If you expect it, you will kind of see that it's a journey, and you'll see that there will be light at the end of the tunnel. It will just take some time as well. So yeah,
And
that's all.
there might be some future tunnels as well, which you have to work through. And then this goes hands in hand with principle number 4, which is manage risk tightly. These go hand in hand, and they're kind of this is almost an applied version of planning for failure. So manage risk tightly. You hear manage risk all the time. What does that actually mean? It means managing your position size and stop loss system to make sure you're never getting out of character in terms of your risk and exposing yourself to the potential for a significant drawdown in your account that you can't, come back from. And risk management is essential. This is what's going to keep you in the game for decades and allow you to compound and really grow your account over time. It's the most crucial skill in trading, especially if you're new. This should be your focus. And we talk about actually practical things later on in this webinar that you can do. And we have an entire webinar and chapter in the Trader's Handbook dedicated to specifically this topic. So again, just understand that losses are inevitable. Almost 50% of trades will end up losers, but the key is to keep those losses to, -3% on the position, -4%, -5%, max -8%, and then have your winners basically pay for those by, exposing that asymmetry, taking advantage of that, and having them be 5%, 10%, 15, 20% plus winners. And so one of those wins can pay for all of those losses. And that's exactly what we see right here. One winning trade can offset many losses, but only if we keep those losses in check through stop losses. And what you want to do is also buy correctly. And this is kind of a underappreciated part of risk management, is actually using a practical and effective setup, edge, and entry tactic that has an edge in the markets. You experience a lot of losses. It might be because you're actually buying at the right point, which is a common trading problem, which we'll address later on. But, one of the best ways to manage risk is to enter at a point where you can exit very quickly if the trade doesn't meet your expectations and, breaks the wrong way. And we'll get into that later on. And lastly, I think this is probably one of the most important lessons we can pass on to you in this webinar series. And this is a phrase from Ross Haber, who, of course, many of you know. And this is one of the biggest things that he's kind of, imposed on me, and I've learned an immense amount from him. But this is one of the key things that is my favorite takeaway. Use tight and logical stop losses. What does this mean? Tight means within a few percent. Logical means you're managing risk at a level that is significant to the pattern, whether that's a moving average, whether that's a high or low. You're basically managing risk and setting your stop loss at a logical point where it would break expectations for the trade if the stock violated that point. So combined here, you're basically only looking to enter, and this is key, only looking to enter when you can place a stop loss tightly within a few percent and logically, so it actually makes sense for the setup and entry tactic you're using. And what this does, it allows you to eliminate a lot of the random entries and entering too late, entering extended, because if you can't manage risk with a tight and logical stop loss, you're not entering at a proper setup and entry tactic. So I think this is really, really key. Rai, anything you want to add on managing risk management, stop losses, anything like that?
I think this is key to your survival, and the longer you survive, the better your chances will be to eventually succeed. So, some traders will uh, allow a trade that had, let's say, a 3 or 4% stop loss turned into a 30 or 40% loss eventually.
Yep.
Why is that? One, because they feel like the stock will come back. Something happens in their mind psychologically where they feel like now the a trade has now turned into an investment. And you really want to make sure that your objective in the market is really clear. If you're investing, you have to trade things differently or invest differently. And if you're swing trading, there are going to be paper cuts or losses that you have to take along the way, even if that means that, you take a 3% loss and the next day it's up 7%, right? All of those things will allow you to learn. And trading is not about being perfect, right? It's not about, the next 10 trades have to be a perfect trade for you to succeed. There's no such thing as that. If you have a 30 to 40% win rate and you're taking paper cuts or losses along the way, it's all about just avoiding big ones, right? If you avoid big ones, it will allow you to survive. It will allow you to build experience. It will allow you to learn from every loss along the way, and it'll allow you to get better, inevitably. So just make sure that you define a max loss rule. It doesn't matter what the stock does after you take the loss. It does not matter. But if you have, a 5 to 7% max loss rule or whatever the case might be in your personal trading, it's just important to have one because there's a lot of delusion, psychological factors that come in that turn a stop loss of 3 or 4% to 30 or 40%, and you're hurting yourself at that point because you'll remain in that one name, you'll continue to hold it, you'll continue to seek, something that's out there where it will look like it's a positive situation. And I know many traders right now recently in Tesla, for example, right? Tesla came out with FSD. They're getting into humanoids, robotics, all this and that. It looked really rosy. Folks that never talk about the Tesla stock started talking about it. They got heavily invested in the $420 range. And now you see that the stock's now pulled back 36 to 38% in a matter of weeks, right? Now swing traders are turning into investors, and investors obviously will remain, underwater for quite a while because the stocks pull back. So as for swing traders, if they took that 3 to 4% loss, you can move on to and catch the next bus, right? A lot of traders and market wizards say there's always another bus to catch. So you want to take your losses frequently, and it will help you get better. Actually, I think every loss, if you look at it, will make you a better trader. So
Yeah,
that's cool.
one of the exercises that Dr. Wish, who was the first person I learned trading from, was at the end of our trading. We did kind of a trading simulation and had to mark up every single trade we make. He really had us analyze any loss over $500, and we were using a 100K account. And that process of analyzing every loss that got out of character for our risk parameters teaches you so much about what you're doing wrong and what you can do better and improve on and apply to future trades. So I think that's so important. And Ra, you mentioned, market wizards. I think in this book, every single one talk about risk management. And there's a reason that they're market wizards. That's because they're talking about risk management and focusing on that. So I think that's so important. And by the way, everybody thinks my background is fake, but that's just proof that it's real. So
There's actually a book there.
yeah, and we'll have our book there too in just a few weeks and months. So that'll be fun. All right. The last one, think in cycles. So this applies both to kind of trading and also your learning experience. We've gone through a period recently where less is more, cash or shorting is kind of the way to go. That's, less often the case than in a strong uptrend where we can be taking steps alongside, but it does happen. There's natural cycles and fluctuations, times to press on the gas, when to step back. Your strategy should be able to adjust to uptrends, downtrends, choppy markets, sideways markets, kangaroo markets, whatever the hell that is. Your system should be able to be resilient and deal with all that and identify the changes in environments as well, because that does impact your trading. Basically, you should ride strong trends, but know when to take profits and exit. Top traders capitalize on cycles. They analyze them in real time. They don't fight them. They're trading with the longer term trends and intermediate term trends and adapting as those change and fluctuate. And my last point here, I think, is really key, and it's great. And props to you guys for attending this. Learning also comes in cycles. Early on in your trading, that should really be your focus, is just to gain as much knowledge, exposure to ideas as possible, and then go apply that to your trading. It's no good learning and attending these webinars if you don't actually apply it and make new rules, test things out that you learn. But there's always kind of a cycle between learning, applying, learning, applying, and gradually you'll kind of refine your process and get closer to the system you want to create. But basically, my key point is here is there's always something new to learn. And props to you guys for attending this and working towards improving as a trader. That's the first step and the most important thing. And I think it's really the passion for this game that drives us to keep learning and keep improving. And it's passion that will create market wizards and allow you to really do this for decades. I think that's really key. Ryan, anything to add on thinking in cycles?
I would say one thing is to when you're struggling to step back and review exactly why. I think traders want um, infinite amount of success in a short span of time, and I've seen traders focus on I want to catch the next gap up, or I want to do this so quickly that it just happens overnight. So while they continue to struggle, right? So if I've spoken to people that have been down 30, 40%, or even, 60 to 80% in their trading career, but when you ask them, have they stopped, trading for a week or two, 3 weeks or a month to just step back and review what has happened, right? Why has it happened? What's the reason behind it? And the consistent answer is no, I haven't stopped trading because I'm looking for that one trade, which will allow me to recover everything all at once, right? So I think it's the most important is this is not a lottery ticket that you're buying when you're placing a trade. It's not something magical that will happen, right? We're not in a casino where, the sevens will line up and you'll just, that's it. It will all happen. So it's not about that. It's about, a series of trades. And just when you face difficulties, take a step back, reassess, look at what you're doing. Like Richard said, learn from it and then refine it. And that cycle of learning, testing, and then just improving your strategy, the more loops or iterations you run through that, the better you will get. And I think the biggest thing to kind of talk about here is that initially, I'd say the first 10, even 15 years, just trade in sync with the trend of the market. So if we look at the S&P and the Nasdaq as of March 15, 2025, the trend is down. We're below our key moving averages. The trend of the market is down, and I still see traders who are very new and they will try and go and pick a bottom in the markets, right? So a simple way to be on the right side, especially in your initial years, while you're building that experience, is to just trade with the trend. It's it's the easiest thing that you could do to see success. Yet many traders will continue to ignore that and then continue to struggle, but then not even look back and look at, take a step back and review as to why they're struggling. So that's just what I wanted to add there, Richard.
Yep, for sure. And in the chat here, and if you're watching the recording here, put it in the YouTube comments. Which principle of the five is most important to you? And probably they're all important, but which one do you relate to the most, or which one are you focusing on right now to apply to your trading system? And just to review, these are the five here. So one, keep it simple, stay focused, plan for failure, manage risk tightly, think in cycles. So which of these five do you think is most important to you and how it applies to your trading right now? I see risk management, keep it simple, manage risk tightly, plan for failure. So most people say risk management and plan for failure. Nice, good. Think in cycles. And I think it fluctuates based on where you are in your trading journey as well, as we'll get into what you want to focus on and how you can improve. So great to see you guys' thoughts there. Perfect. All right. So, Rai, I know you've got a lot to say here, so I'll leave it to you.
Yeah, so this is one of the uh, a visual that was posted by Richard Feynman, if hopefully I'm saying his
Feynman, yeah.
Feynman. But it was one of the early visuals, and definitely follow him on Twitter X. a really good follow. Like
I don't
he
think it's
talks
actually
about
him, but it is a good follow.
yeah, yeah.
Yeah.
There's a handle out there that actually like summarizes and posts videos about him. And he was a really good teacher in his times. But this diagram I got from that handle essentially is that knowledge will get you your it's your first step or your first move, right? And you will accumulate that in different blobs. So let's say you're listening to Richard, you're listening to me, you're listening to Ross, Nick, etc., right? But what will stitch that knowledge together is when you go out, apply it, build that experience, and even there's some knowledge that you will feel doesn't align with your system, your strategy, your lifestyle, and where you are in your trading journey, and you will drop that knowledge. And that will only come through experience. So experience is kind of stitching together the different pieces that you learn. For example, my stop loss rules, there are some that I picked up from Ross, right? Never let something run more than 7% because, there's mathematical reasons to that. That's something that, William O'Neill taught me. Um, Look for tight price action with volume dry up. That is something that I learned from Mark Minervini or many of the greats in trading. So these are blobs of knowledge that you will pick up. And then when I applied that, I saw that certain rules for me and my lifestyle and how I look at it, how my brain works is more of an engineering brain. Then that experience is how I made my own system. So it's very important that you accumulate knowledge, but you apply that knowledge and you'll see what works for you, what doesn't work for you over a span of time. So um, yeah, that's what I want to say.
So now we want to pause for a second and we're putting a lot of effort in these 12 webinars to share our experience, our learnings, frameworks to improve on different aspects of building a trading system. And what we need from you guys is to meet us in the middle here. We want you to really dedicate your time for this. Make sure you're taking notes, doing your utmost to learn from these webinars, and like Rai said, apply the knowledge that we'll be teaching. It's no good if you attend this webinar and study passively and never revisit the material again. Take the things we talk about in these webinars and all the knowledge that you're gaining from books, different resources, and apply it. That's the most critical thing. If it doesn't work for you, it doesn't work for you, but you got to apply it to actually see. So here's a quick sentence or two that you should write down in a journal here, or even better, tweet out on Twitter and tag us, and we'll respond and retweet. Basically, you want to say, I, and then insert your name, will do my utmost to make incremental improvements and put in the work that will allow me to learn and improve as a trader. I will establish routines, read books, and conduct studies, and otherwise look for ways to extend my knowledge base and perform at my best. So this is really important to make this kind of pledge to yourself, because really, at the end of the day, this is a contract to yourself. Business trading is a serious business and can completely change your life, but only if you work hard at it, treat it like a business, and like we say here, do the work to actually implement all the knowledge that you're gaining. And you can say it in the chat here. You can say it on Twitter and tag us. But it's really important that you write this down in some way. Speak it to the world. Goals have a magical way of coming true if you do speak them out into the world. I found that in kind of what I've done in the past. So definitely do this. Tweet it out. Whatever you'd like to do. Right. Anything to add on this pledge for people to think about?
I just feel like a lot of people, as long as you apply what you hear today, if the only thing that you take away is that you have to take losses quickly, I think it will improve your trading, right? It
Yep.
doesn't have to be everything that we say, but if there's just one takeaway, I think it will help you in your trading. So, just over the next 12 webinars, as you guys come in and attend, ask the questions that you have, question what we're saying, as well. And we'll definitely, it's a two-way street where we'll be more enthusiastic, have more energy. We're seeing more participation, and we're seeing people coming in, more enthusiastic, asking us things, etc. So it will be a marathon. We did this about, I think, a year and a half ago,
Yep.
but I think many traders really loved it. We had over, 100 to 150,000 folks attend or watch on YouTube after the fact, which is amazing to see. And the enthusiasm was there, which we want, in this new series that we're doing as well.
Yeah, and another thing to add there, if you find this series helpful that we're doing, please, share the word, share it with a trader friend, share it on Twitter. Again, that just, motivates us to, give even more. So definitely help support this resource as we're building it. All right. So with that said, let's dive now into the stages of trading, the kind of next key section of today's webinar. And Raya, I think you can take the lead with this one.
Yes. So this is one of the diagrams we I came up with a while ago to is really based on the mentorship that I've done and Ross has done and Richard's seen. We broke it down into the four stages. The first one that we commonly see is the unprofitable stage, where a trader just is new. They maybe see beginner's luck initially, which gets them really interested in the markets. And then after the beginner luck fades away, they enter this unprofitable stage. Many of the common issues that we see and we've discussed is, one, they don't take their losses quickly. They're placing trades with no real system. They saw success in the markets, which was quite random, and they felt that that randomness will continue, but it doesn't. And that's the first stage. The second one is boom and bust. So the boom and bust is where you kind of figure out that this is not a casino. Beginner's luck has faded away, and you come to a realization that you know, the market is requires some, dedication, and knowledge and experience in it. In this boom and bust stage, you see really large wins, and that excitement equally is taken away when you see a large loss. So you have something that's kind of working. You don't know what it is yet, because you haven't kind of sat there and looked at why are your large winners resulting in huge, gains, and why are your large losses, you know, taking away all those gains. Some of it is psychological, some of it is system related, some of it is you're still building experience in the markets. The third one is the consistency stage. This is where you've learned, I think the biggest thing you learn from stage two to stage three is that you can now control your risk. And when you get to control your risk, you can keep your large winners for longer spans of time. But when you do have a loss of 3, 4, 5%, you curb that loss, which again allows you to have asymmetry in your P&L, and it kind of curb, you see your P&L starting to be a bottom left to a top right type of situation where it's trending in the right way over a year or two or three. The last one is when you combine a good system with a high level of experience. You've combined that the same diagram that we spoke about where your knowledge is now stitched together with experience, and you really are focusing on what works for you and what doesn't work for you. And that's the last stage, which is the performance stage. So each of these, I think the first thing that you guys want to do, maybe in the chat or if you're watching afterwards, is to just do an honest self-assessment of where you're at, right? Identify the stage that you're in, even in the comments right now. If you could put, if I'm in the unprofitable, boom bust, consistency, or performance stage, and I think that's the first thing that you could do is a honest self-assessment of where you're at. The second is to track, and a lot of traders tend to ignore this in the first two stages, is to track their equity curve. Your equity curve is a report card or a realistic measure of where you're at in the markets, right? And you could plot it, if you have a broker like IBKR, they will plot it for you. But you want to take a look at that equity curve to see what's happening. Is it fluctuating a little too much? Are you not able to handle the volatility of it? Do you have moments in the market that are amazing, followed by moments in the market that are not so amazing? But all of that assessment is all tied to tracking your equity curve, right? And the goal here is once you do that on a self-assessment and you track your equity curve, you can then progress from one stage to the next, right? And It will allow you to set a goal for yourself. Hey, I'm in the boom bust stage where I'm seeing large wins and large losses. Over the next 3 to 6 months, I'm going to take a look at why am I having these large wins? What's the reason? Most of it always has to do with market trend and being in sync with that. And then what happens with the losses. If I have my average loss be 8 to 10% in the boom bust stage, I can set a rule that says if I have a stock and it reverses on me more than 4%, right, I will cut that no matter what, right? That math will then skew in your favor. It will show in your equity curve. While you'll have large wins, you'll have smaller losses, and the math itself will work out. So that's what I kind of wanted to say here is to identify the stage you're in uh, and really do an honest self-assessment by looking at your equity curve.
Yeah, and I'll say one thing I found helpful when analyzing my equity curve is also plotting the QQQ or SPY along with it. So you can see how the fluctuations you're going through with your performance tie into the changing market dynamics. And that can give you insight to say, hey, I'm really good at picking the turn in the market, but when we transition back into a correction, I give it all back. I'm a boom and buster. So that can be really helpful as well. And then here are some other kind of leading questions that you can ask yourself. Do you have trading rules? A few people said no. A few people said they still need to work on them. This is part of transitioning from stage one to stage two is actually having a trading system defined, especially with risk management, that allows you to progress. So there's some simple, but not easy things that you need to do and implement to progress through your stages. And we'll get into even more detail about each stage and how you can progress in between them shortly. But I just want to say, that equity curve point I think is so important. These equity curves here are kind of templates that you can apply and look at and compare your equity curve to. Obviously, this one more downtrending. You've got often an initial powerful move that hooks you in. Maybe you caught Tesla with 100% of your account in 2020, but you just haven't seen that performance since. Then you've got the boom and buster, where maybe you participate in the uptrends, give it all back during the corrections, uptrend, correction, uptrend, correction, and overall it's kind of flat to even more downwards trending as well. Then profitable trader, you start to see higher highs and higher lows. You do give a lot back during corrections, but you're making steady progress and increasing your equity from left to right. And then the performance phase, and this is a phase which even the best traders are in. They're always looking to improve and get better and gain new edges. And even them might have periods where they're not trading well and they transition back to a boom and buster for a little bit of time. But their overall equity curve will be, a clean trend, higher, lower, higher highs, higher lows from left to right. And they give a lot a lot less back on average during the corrections than the profitable traders in the consistency phase. So this equity curve and that analysis can really help you analyze and be truthful about what phase and stage you are in. So let's dive into and yeah, put in the chat right now or in the YouTube comments what stage you're in. I saw a lot of stage twos, a lot of stage threes. Saw stage 2.3, 3.14, 15, 926 in there, 2.718. So yeah, just try to be honest about where you are, which stage you're in currently. And I do see some stage ones, and that's perfect. Everybody starts there, and you can implement
It
stuff
can
very
move on.
quickly and progress. So you have the most potential if you're in stage one. So stick with it, have confidence, understand realistic expectations that it will take some time. But let's go ahead and dive more actually into that stage and Ryan maybe give it another description of
Yep.
it, and then we've got a slide about how to progress. So yeah, we'll start here.
Yeah, so stage one traders really have a few things. One is a lack of system. So entries and exits are completely random, often based on, I'd say, someone else's stock picks or tips. And there's a heavy level of emotion involved in their trading rather than strategy, right? The second that we've spoken about is there's just no risk management. There's no definitive stop loss, there's no definitive max loss, there's no definitive position sizing to control the math of your trading. And when you don't have that, it's all based on emotion, where an uptrending market, you'll swing for the fences, it will work. And as soon as the market turns a little sour, you will have a really hard time and you'll give back a lot more because there's no position sizing to skew according to market trend. Third is you're chasing, I would say, quick gains, right? So you're position sizing big with emotion, and sometimes it works, but uh, 60 to 70% of the time it won't. And chasing quick gains will result in it's no, chasing quick gains is like when we buy a lottery, we're chasing a quick gain, right? How often do you win the lottery? You don't win often, right? The fourth is you'll have fluctuating styles. So the traders often one on Monday they are day trading, on Tuesday they turn into a swing trader, on Friday, they're trading options, and Saturday, Sunday, they've become a crypto trader because the market's open, crypto market's open, and the stock market's closed. So fluctuating trading styles, again, with anything, whether it's building a business, building your trading system, uh, you know, anything requires laser sharp focus. And you don't see, for example, I would say, um, Stan Weinstein wake up and only trade stage analysis on Monday, Tuesday, and then switch to let's say VCPs the rest of the week, right? So Mark Minerini would not, stop trading his SEPA system because they're all laser focused on the system that they have built for themselves. There will be in stage one, there's still boom and bust cycles because that's what kind of keeps you in the market. You become a source of income is what I like to say for others because you have a lack of trading strategy, you have no risk management, you're chasing quick gains, and the money that you're putting into the market is being consumed by others. So you become a source of income for others. So some traders in this stage, when they commit to really learning, slowing down, looking at what they're doing, um, you know, this stage is all about like impulsiveness. It's all about a lack of structure. It's all about taking unnecessary risk when the market turns sour and you're just in a downtrend. So we can move to kind of Richard, how we progress
Yeah,
from one
I
to two.
yeah,
Before,
I just said
yeah, you can add some.
yeah. So basically, what Rye said, at this stage, you just have to commit to learning. Many of you I know mentioned, watching my interviews and watching our material, and that's perfect. But you have to go ahead and apply that. But read books, watch interviews, take notes, write your first set of trading rules. Establish entry and exit criteria. What does a buy look like? What does a sell look like? Implement strict risk management. This is so important. Just this fact, having a stop loss on every trade is a big step into progressing from stage one to stage two. You want to develop a system as well for stock selection and entry setups, and you want to be as independent as possible. I think it's completely fine to learn from traders, but whenever somebody puts out a stock symbol or mentions something in a report, you want to interpret that through your own lens and your own process and not just blindly follow them. You want to try to learn from, why did they select that stock? What are they seeing? What are they looking at to pick that stock? So learn stock selection and develop your own process for yourself. Then, very similarly, adopt sell rules, have a clear cut reason for closing your trade, whether it's a break below the moving average or whatever. We're just trying to eliminate the randomness that is so rampant in stage one. Where everything doesn't have a rhyme or reason. It's based on fear, greed, emotions, social media tips, all of that, and just overall hype. So we want to first things first establish a process, and that's key to transitioning from stage one to stage two. And the key takeaway is the goal is to transition from a random trading to a structured approach with clear rules. That kind of sums everything up. Ryan, anything to add on this slide that you
Just
already?
say,
Yeah.
discipline and structure in your decision making will remove impulsiveness from your trading, which will allow you to progress from stage one to stage two.
Yep.
Yep.
For sure. All right. So next up, the boom and bust trader, stage two.
So this one is character mostly it's about you have more knowledge now, right? But your execution and the way you go about trading is still a bit inconsistent. That's what results in big wins and then big losses. There's a lot of volatility in your equity curve when you analyze that and you look at, there's swings in the market or there's swings to the upside in your equity curve, but then you give it away. And the primary reason for that is you're still developing your risk management skills, right? You're still developing that you're still coming to terms that you have to take your losses quickly, essentially. Um, Stage two also kind of heavily depends on, I would say, less about developing feel for the markets, but you're very heavily reliant on, an indicator or two, and you haven't come to the fact that there's a little bit of an art to trading, right? No indicator will be successful all the time. You're using the same strategy in a good market and a bad market, and that's mostly because of a lack of a market cycle system or a lack of awareness of how a good market is something that we saw late last year to early this year, and a bad market is the one that we're in right now since the last 14 days or so. So the more stage two traders when they kind of lack the awareness of that the fact that the market is cyclical in a way. And when they figure that out, that's how they become stage three. So I think those are some of the characteristics for stage two um, as well. So I know you have the transition slide up, Richard, if you want to go first, and I'll add some
Yeah,
things.
just wanted to double click on what you said. I think building a market cycle system and having that awareness about are we in an uptrend or downtrend, very simply, because like you said, I think stage two traders take the same actions, whatever type of market they're in. And but depending on the market is what the results will be. So you can buy a breakout in an uptrend and be rewarded, but that same breakout is going to get stuffed if we're in a downtrend and institutions are distributing overall. So I think that's really key here and almost should be in bold. Also, I think narrowing your focus as well, really refining your system, I think is really important. Probably a lot of stage two traders, they're gaining all this information, which is great, but they're trying to trade an earning gap. They're trying to trade a VCP. They're trying to trade a pullback to a moving average. They're trying to do all these things at once, five different styles, five different setups that are all a little bit similar, but need overall, mastery to really be traded well. So focusing on just one or two and probably just one to start is probably key here. I think at this point, transitioning from stage two to three, also studying winning traders, what they do well. And again, not blindly following them, but studying what they do, their process, really their routines, all of that, how they approach the market is more important than, their setup or what, what their results are. And also studying previous market leaders. We put out a TraderLion model book every year. We're about to launch one with Stan that basically analyzes the market based on our methodology and how we would have applied buy rules, sell rules, risk management, all of that. And you'll learn so much by going through previous charts of winners and notice setups and opportunities and patterns that then you can use as a template, a blueprint going forward. Then an increased focus on leading names. I think also there's some shiny object syndrome with stage two where they're focused on any stock that's moving, whereas stage three traders and definitely stage four are a lot more laser focused on the top opportunities. Maybe those top opportunities aren't set up right now, but they're patient. They're waiting for their spot to apply their entry setup, entry tactics to get into those leading names that have the greatest potential overall. Then again, here this is part about building a market cycle system. Refine your trading rules based on added experience that you've acquired, and then still focus on risk management. Risk management is key. Making sure you've got that nailed down is key to going from stage two to stage three. And kind of the key takeaway here is the focus shifts from gaining general knowledge to mastering one approach, and refining execution. So I think these are some key things to work on. I know a lot of you are in stage two right now that commented and are watching this right now probably. So pick this up right here and focus on that. Pick focusing on leading themes and working that over the next few months. Pick one of these things and apply them all over time, and that's how you'll progress from stage two to three. Ryan, anything to add based on what I just said?
No, I think, one strategy, figure out your time frame, study the most winning stocks and the most, successful traders that you know or want to emulate. I think emulation at this stage um, is important because it allows you to refine your trading rules and your system. When you see someone else be successful, there might be a reason for that. Now you'll pick up bits and pieces from many different traders, and start to piece together your own system, which has like entries, stop losses, position sizing rules, and how you will um, buy and sell in the markets essentially. And the last bit of it, I think the progression from two to three is also just experience. Um, Time will kind of heal all if you can survive in the
Yep.
markets. Time will heal a lot of your mishaps, um, and you'll learn, a good market from a bad market. And some things can never be taught, but only be experienced. So that last part of it includes, building that experience to get to stage three. So you can read all of the books, but when you get hit with a large gap down, for example, you will learn from that gap down, right? You can see a trader talk about his journey and how they stepped into a landmine and blew up their account. But when you actually do it for yourself, that's the best learning that you will come across in the markets. And those things, like we said earlier in the webinar, is those will happen and expect them, and you'll be much better on the other side uh, to transition to stage three.
Yep. All right. So here's stage three.
Stage three, I would say some of the most important things in stage three is one thing about getting through one and two and getting to three is you have some sort of passion for trading the markets. So you're committed, you're highly committed to learning. For me, stage three was I read a lot of books, ones that included trading journeys, ones that included trading psychology, ones that included systems that I knew I could never trade because they don't align with my lifestyle. But I was committed to learning everything that I possibly could that exists out there. And that still kind of happens, every time there are new books that come out. I tend to do that because I enjoy it, I'm passionate about it, and I'm committed to, you know, getting any sort of edge that I can possibly get. Second one is I think it's important that if you want to kind of expedite your stage one, two, and your stage three to look for mentorship and guidance that exists. If someone's been there and done that, or if you want to learn golf from someone, it's pretty clear who you would go to. If you want to learn basketball from someone, you would go for the best mentorship and guidance that exists. And I think some of it gets a bad rep, but mentorship and guidance for me personally, early on was Mike Webster, then Ross Haber, um, and Stan
Now me.
Weinstein. Uh, um, like all of these people have played a really key role, right? A recent example, and I always have been saying this, is I was searching for a reversal setup to kind of add to my toolkit, and I tried everything. I did that, and then it all clicked with while being, look when we were doing the stage analysis master class, right? The 4B minus, and that was through mentorship and guidance, where Stan was directly involved in that, and I think many traders should seek that because it will kind of shorten your time span, but it will get you where you want to get to a lot quicker. So stage three also involves consistent, execution of your system. And the biggest one is you're now aware of the market and how it trades in cycles. You have a market cycle system, which we'll speak about extensively in future webinars. You have a system that will get you into the markets, keep you in the markets, and you'll also have how to get out before things turns really, really sour. So you'll have a clear market cycle system. You're aware of when you want to step on the gas and you're aware of when it's time to step back because nothing that you will do aligns with your system, and you don't want to give that money back. And that's really why the equity curve is dancing from the bottom left to the top right slowly in stage three. um Richard, you want me to speak to just improving as well? Like stage two, you know, transitioning or uh, getting to stage three, it's all one setup or one strategy. You're highly focused, and you're specializing in one thing, right? Um, the other thing is risk management. You have a clear expectation of you will take your losses when they need to be taken, how you will position size, which I think, stage 3 to 4, it gets even better in terms of position sizing. And your confidence in stage 3 is growing, right? It's getting better and better because success breeds, I'd say, confidence. Like when you see a gain, you know that, okay, I know why this happened, and if I can emulate that a lot more, and your sizing will get a lot better, you will get to stage 4 that way. So, um, that's what I wanted to say for that.
Yeah, I think from my interviews and talking with a lot of traders, I think the position sizing it is a key thing that unlocks that next level of performance, but you can't just jump into it. And I think I say somewhere on these slides, it's like weightlifting. You don't go to the gym and your first session you can bench 300 pounds. Like you, and most people never get to that, right? You have to build up to it. First, you master the technique. First, you bench the bar. Then you eventually work up to putting your first pair of 45s on the bar, and you progress from there. So you have to earn the right to put on more weight, and similarly you have to earn the right to size larger in the markets. But that sizing leads to the strong performance because these traders who are transitioning from stage 3 to stage 4, they know exactly when to size larger, what names to size larger as well, what time in the market cycle to put on larger positions, and they manage risk expertly throughout the way, along the way. So I think that's a big key that enables that next level of performance. But again, you have to work up to it. You don't want to try to jump from stage 1 and stage 4. You don't want to size like Mark Minervini when you just started trading. That's a recipe for disaster because you haven't mastered the fundamentals that build up to a foundation to be able to do that. So I think that's really key. So here's the performance phase. Right? Anything you want to add on the performance phase here?
Um, in the performance phase, it's not like the be all end all type of situation. All you've done is you've gone through the paces or through the ringer in stage 1, 2, and 3, and you've mastered your some system, right? So if we look at successful traders, Stan Weinstein built the stage analysis system. He still trades that to one, today. Minervini built the SEPA system, which was heavily influenced by William O'Neill, growth stock trading, Wyckoff, and things of that nature, right? Um, stage 4 is about doing your routines when the market is in a downtrend, not only when the market is in an uptrend. So you've built this high discipline because you know that when the market is ready, you have to be ready for the high potential stocks because if you don't do that, you will lag. So there's a high level of discipline regardless of situation in the markets. You know when to be aggressive. I think the biggest thing is you figured out, you know, um, early in a market trend, your position sizing will be a lot heavy because you'll see a big increase in breadth in the markets, for example, and you'll make that initial progress because everything in the market or the market floor is lifting higher, right? And when things don't work, and stage 4 traders still run into string of 6 to 10 to 12 losses in a row, but they have confidence that their system will ride, you know, um, their system and their process will take them through these losses, and eventually they will come out on the right side of it. So they don't start changing their system just because they've had 3 or 4 or 5 losses, let's say in a row. So it's important to understand that stage 4 traders still have losses. But over time, as you're in stage 4, you learn to be selective and really patient and wait for the right conditions. Even if that means you're not trading for the next 2 months or 3 months, and they will wait, 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 and wait. And when the time is right and they feel like everything's in their wheelhouse once again, they will use position size as leverage to catch up in performance. Or if it's the only thing, the only way they're making an income, that selectivity and that patience will allow them to um, make the money that they need to make as a living, right? Um, as stage 4 traders. So you'll see higher highs and higher lows in your equity curve. You have this patience and calmness about yourself that you have mastered some of your emotions, even though it's like not fully there ever with emotions, but you know when the time is right. And there's such confidence because you're not, you know, Trader Joe said this on this feed and he's long and I'm not, I'm in cash. Am I doing something wrong? That is all out the window. You're just waiting for the market to turn and come to your wheelhouse. And then you're executing with full confidence. So the last thing that I'll say with stage four is it's not, you know, it's not, you're not perfect yet. You continuously continue to, read books, learn, attend webinars, um, listen to traders. There's new successful traders that come about. Like if we take a look at the USIC recently, folks like Marios, Leo, Leos, right? Um, Folks that, Richard's interviewing all the time. I watch all of them and for me, I get a gist of what they're doing quite quickly because I can see and I've been there and done that. And I take certain aspects that I feel might help me still uh, to improve my system gradually as well, right? I'm still weak at, for example, um, I'd say, position sizing in the leadership names the right way. That never, even if you talk to Ross 30 plus years in, it's still something that is being worked on, even for him as a trader. So you're always trying to chase, I would say, that perfection, but you will never reach that perfect state, right? But you kind of still hack away at it, bits and pieces to consistently improve. So Richard, if you want to add anything there.
Nothing much to improve. Just to reiterate what you said about stage four isn't like a destination. It's like just it's a constant state of evolution. You're still working to improve, like you said, still watching interviews, reading books, trying to pick up bits and pieces every there. Just it's about refinements. It's not necessarily about game changing changes. So stage four traders perform studies, gain new edges, refine their execution. They really focus on what they're own doing, their performance, their stats, all of that. And just refine everything that we talked about with stage three. So I think that's the biggest takeaway. So with that, we'll take a quick Q&A break, answer some questions. Here's again that QR code to register for the interest list. Again, we're sending out a lot of bonus articles and education through that list, so definitely sign up, and you'll be the first to know about giveaways, these webinars, all of that. So definitely sign up here, and let's see if there's any key questions that we want to cover here. Let's see here. Wow, there's a lot of questions. I don't know if we'll be able to get through all these. Let's see. And Ryan, if you see anything, just feel free to start answering.
Yeah. Do you use the same level of stop loss for day trading than for more long-term oriented trades? I think day trading and long-term oriented trades require a completely different approach. A day trading system may look at anywhere from a 1 minute chart to a 65 minute, maybe the daily as well. Whereas a long-term system is likely a weekly, monthly situation, and they both have to be treated really differently. So it's it's not an easy question to answer right now with a few examples, but make sure that your stop losses for day trading are likely 1 to 3%, whereas for long-term trades they might be 7 to 8%. So, do you wait to place stop loss immediately or wait for some period of time? That's a good question. For me, I am actively trading, so I'm at the desk most of the time. I have alerts and things of that nature set up. So, at where I am right now, I am actively looking at my trades, and I know where I will exit or where uh, my thesis for that particular name will be incorrect. So, but if you're working full time and you're stepping away and you're placing trades that way, always determine your stop loss before you place a trade. There's always a spot on the chart where everything that you think um, is going great will not be so great. So know your stop loss before you enter a trade, especially for stage one, two, and three traders.
There's a question, and we'll cover stop losses in a future webinar, but do you treat a TEM, which is a much more volatile, faster mover than like an Amazon? And for me, I'll position size differently. But my kind of stop loss structure based on structure is kind of the same. It's just I might size a little bit differently and use faster rules as well, just because it's a faster stock. But Rye, how do you handle like a fast mover versus a more liquid, slower type mover?
Yeah, so one way to measure that is just the average daily range. So a TEM will trade a lot differently than in NVIDIA, for example. TEM is less more volatile. There's less supply in the markets, whereas NVIDIA will get really tight for multiple weeks. So you have to just know what you're dealing with. And if TEM is more volatile, you could reduce your position size to account for the same volatility. Whereas NVIDIA, you can really manage your risk tightly and let's say place a 2 to 3% stop loss, and your position size can align to it accordingly. So I guess for me, it all comes down to a TEM I can buy, you know, less dollar amount, get the same results out of it while managing my risk. Whereas an NVIDIA, I can really buy a lot of NVIDIA because my risk is 2 to 3%. It's not gonna, move down 14% in a day on a reversal day. Um, Even though that might have been the case recently
Recently.
with
Yep.
the
Yeah.
with the DeepSeek and all that. So.
All right, well, let's keep pushing forward because we're already an hour and a half into this, so hopefully you guys are enjoying this. Um, the next section is on common trading problems, and these are things that we've realized and seen over and over after mentoring thousands of traders. And these are the common things that traders come up with, especially when they're stage one, stage two, trying to transition to stage three. So we thought we'd address a few here and kind of think of, give you guys frameworks about how to solve these and think through what's actually the root cause of all of these. So here's a list of some of them: system hopping, FOMO, oversizing, buying extended, buying late. This is an issue I had early on. Over trading, too many indicators, randomness, lack of risk management, overconfidence, no sell rules, underconfidence, no post analysis. There's a lot of others we could have named here, but in the chat right now, and you're in the YouTube comments, if you're watching the recording here, I want you guys to list out kind of the top one or two that you're experiencing, over and over right now that you're currently dealing with. I think over trading is a common one for stage two traders, where it's about that kind of lack of awareness about the market environment too, is they're trading too much in a choppy downtrading environment. So this is a kind of a key one for stage two traders. I think everybody experiences FOMO to some extent. It's just about the seat time and realizing there's so many opportunities out there. And then system hopping, I think, is really occurrent in stage one traders. But let us know in the chat here what you're mostly dealing with. Let's see some of the responses. System hopping, FOMO, over trading. A lot of people saying over trading, buying extended late. When we cover our edges and setups webinar and entry tactics, we'll address that specifically. Need to do more post analysis, over trading, FOMO. So it sounds like a lot of you are experiencing some of these: FOMO, over trading, buying late, buying extended late, FOMO. Awesome. So this is completely normal. I don't want you guys to feel alone about experiencing this. Again, it's just part of the transitions between the stages and where you're currently at on your journey when you go through these. Before we get into specific ones and how to kind of work towards improving them, Ryan, anything you want to mention in general about these issues that traders might be experiencing?
No, I think it's important to just write down what you feel is stopping you from being successful, right? Um, it all comes back to, st self, looking at what you're doing. Um, and, if it's multitude of issues like that are listed on this slide, then you need to start to work towards each of them. And how do you kind of build out a plan, right? On how I will stop randomness, how will I no post analysis is just like you just have to do it. And a lot of traders don't tend to do it. So I don't have really much to add other
Yeah.
than, the fact that people are saying that they have these is the first step to doing anything about them.
Yeah, and actually, the first thing I want to say before we get into specific ones is, as a whole, I think a lot of the emotions that come with trading, the FOMO, dealing with oversizing, all of that, I think a lot of it stems from, at its root, like a lack of clarity about your system and almost a lack of trading rules. So if you're experiencing a lot of FOMO, double check that your rules are up to date. And this is kind of an assignment for you watching this. This weekend, go ahead and update your rules if you haven't yet, or haven't, recently, because I think a lot of emotions come into play when there's confusion with yourself about your objectives and what you're trying to do. And it just takes, figuring that out, realizing exactly what your setup is, what your entry tactic is. That clarity gives you confidence and gives you perspective. And if the environment isn't matching what you're looking for, you actually understand, there's no FOMO even if a stock's at 5% off the bottom, because that's not my spot where I like to enter. I wait for the higher low. I wait for the moving average reclaim. I wait for the breakout. Whatever the setup is, and have confidence in what you're trying to do. So just moves off the bottom or big moves up don't really kind of phase you, because you have that clarity about your objectives and all of that. So I think a lot of emotions that come to trading can be helped or managed by gaining more clarity about your system and redefining your trading rules for yourself. But first things first, getting into FOMO. Actually, that's exactly what I just said. If you're experiencing FOMO, I think just getting clarity about your trading system is really important. Setting process goals and realizing that you just need to focus on the best opportunities each year, and that there's so many different ways to get triple digit returns or even 40% returns. And there's so many opportunities every single day, every single week. During a typical trading year, there's like 2 to 3 periods where that's really where you'll move the needle in your account if you catch it. And realizing that a lot of the rest of the time and a lot of the rest of the movement doesn't really matter and impact you. I think also when it comes to overcoming FOMO, just studying the market and previous market leaders and recognizing that even if you miss the first breakout, if you keep an eye on that stock, there's going to be a pullback setup. There's going to be a future earnings gap. There's going to be another base that forms. If a stock's going to go 1,000%, like we saw Nvidia or PLTR, do the past 2 years or so, and there's examples every single year. There's so many different setups along the way that you can catch. So even if you miss the first opportunity, there's going to be another one in the future with that stock, or a completely different stock that has an equal potential as that one. So just recognize that the opportunities are endless. There's going to be multiple times to get in, and often that breakout that looks so good will just pull back and retest the pivot, over the next week or so. So just keep an eye on that stock. If you miss something, just be patient and wait for a spot where you can manage risk tightly and logically. In addition, establish a clear daily routine. If you miss, for instance, an earnings breakout, an earnings gap, and you just saw it late, or you saw it, after the close that day, look at your routine. If your routine has nothing about scanning the market pre-market for big volume moves and gap ups in the morning that will be potential earnings gaps, or the previous day you didn't have anything in your routine about scanning post-market, looking for earnings beats, news catalysts, whatever, then you can't be mad at yourself for missing an earnings gap the next day because it wasn't part of your system to look for it. So if you're experiencing FOMO because you missed a setup that you think you should have gotten, make sure to look at your system itself and see, do you have it set up so you could catch that stock. So that's another thing. Make sure you establish clear daily routines, and that goes along with building your system as a whole. And overall, if you miss a leader, I miss leaders all the time. If you miss something, just study it and try to distill, what made you miss it, what can you improve the next time, because every single year there's going to be 20, 30, even 50 names that give really good opportunities to move the needle. And if you miss one year, you can catch, many others down the line by studying why you missed that stock. So then you can apply that blueprint to the future and just, again, consistent improvement over time. So that's kind of a few things on overcoming FOMO. Right? Anything to add on this slide from your side?
No, I think that nails pretty much um, everything. I think there's also the fact that traders use social media quite a bit now, and they
Yeah.
have access to other people that are consistently, doing great regardless, or are doing better than, let's say, if I'm in a series of losses and nothing that I do is working, and I see someone else in the same situation, like in the same market, doing really, really well, that induces FOMO quite a bit. Naturally, right? Is it something I'm doing wrong or what's happening? So it's important to realize that there will always be successful traders in every type of market, but that doesn't mean that you have to be successful in every type of market, right? So
Yep.
there's a bit of that you have to realize as well. It's a good opportunity to learn what those folks are doing, and if there is a way to learn what they're doing, to be curious about it. But I don't let it get to you that, in a choppy or downtrending market, why am I not up 60% on the month? Well, it might just be that you're stage two and stage three, and they're stage four, and have been trading for 25 plus years, right? So there's always context and reason to things. And I think, there's a quote out there, comparison is something of joy or something like that, killer of joy. Exactly what it is these days with social media and all that. So just keep perspective, is the only thing I would add. There's always a successful trader in every market environment, but that doesn't mean that you have to be really, really great at every market environment. So.
Yeah. And by the way, along the lines of trading rule set, we'll be sending out along with the book a sample trading rule set. So I see a lot of people mentioning that. Sign up for the wait list, the interest list, and that will be one of the bonuses that you guys get. So definitely go ahead and do that. All right, improving risk management. This is, something we mentioned multiple times is key to progressing along your trading journey from stage one, two, three, four. I think here's some practical things that you can do. With every setup and trade that you make, have a clear stop loss and position sizing rules that fully define how you're managing risk for that trade. Again, for a more volatile name, you might need to manage risk more through position sizing than your stop loss. They kind of go hand in hand. Together, they form the max loss that you can take on that position. I think a good starting point, I think most people say 1% to start with. If you're very new, I think, this is a better metric to shoot for because it just lowers your risk overall. But, how you calculate this is basically the position size in dollars multiplied by the stop loss risk on that position, and then convert that to percentage of your total account. And that gives you the percentage that you're risking on any one trade. And even with 0.5%, you can have big sizes if you're keeping your stop loss pretty tight. So don't feel like this is too restrictive and doesn't allow you to perform later on. I think Marius Samatudis, who I've talked about quite a bit, we're doing a boot camp right now. He actually, used to use about 0.5%, but now looking at his stats and looking at his performance and all of that, he's actually lowering it to 0.3% of his account on any single trade, which is pretty tight. And the reason he does that is because he uses pretty tight stops, so it still allows him to, position size pretty big. So I think this is a good rule of thumb to start with. For your top trading ideas, identify in advance. This is just part of creating a trading plan, the tight and logical stop that you will use. Set stops right after you buy in with your broker. I think a lot of beginning traders, just have mental stops, and I think you just haven't earned the right to do that yet. A trader like Rye or Oliver, Oliver actually uses mental stops, but he knows exactly what his max pain stop on a particular day is, and he has a discipline to apply it when the stock hits it. So, you aren't Oliver Kelly yet. You have to work towards that and earn the right. This is just kind of a routine type thing. Each morning and night, check your stops to see if they need to be updated. I think sometimes there's just complacency where you haven't updated a stop and the stock pulls back, breaks where you should have had your stop, and you have a much bigger than expected loss or drawdown off the top just because you didn't do your due diligence and manage your portfolio correctly. So this is kind of a routine type thing, and I think all of these are kind of very practical and something you can apply right now to improve your risk management. And lastly, this is just kind of a way of thinking about it, a mindset shift. A stop loss is a good thing. A stop loss when you buy a stock, your stop loss is basically the amount you're risking is your ticket to actually try that trade. It's your insurance that protects you if the trade goes against you. And the best thing about trading is sometimes you get a ticket refund if the trade works in your favor. So don't view a stop loss hit or the potential your money that you're risking on a stop loss as a negative thing. Just treat it as a cost of doing business. You have to protect your downside. It's just the price you have to pay. And that with that mindset and knowing that a successful trade can pay for many, many tickets and many, many stop loss hits, it just gives you that kind of confidence again that a stop loss hit is a good thing. If I get a stop loss hit, that's a well executed trade for me, even though it was a loss. I think too many people view success or failure based on whether the trade was a winner or a loser. Really, I think you should reframe it on how well did you execute, because even a winner could be a bad trade if you manage it incorrectly, and a loser if you follow your plan and use your stop loss and take a stop loss hit and go out of it with a small loss. That's a very well executed trade, and that should be commended. So again, just think of a stop loss as your ticket for doing business. Rye, anything that you want to add here on risk management?
Yeah, I think bull markets make traders lazy, where they feel like they can get away with doing things like not knowing exactly where they will kind of, take that loss and move to the next trade. A longer bull market kind of does that more and more. And when the trend reverses and things change like they have even recently, I see a lot of, oh, I had this rule and I didn't follow it anymore type of situation because the market was so nice and trendy last year, like likely just like a sideways S, right? We pull back, we go up, we pull back, we go up, we pull back. So it put a lot, you don't want to kind of go into these bad habits just because the market's playing nice with you, right? We always want to remember this stat that, 90% of traders will likely not make money in the markets. And that's because of complacency, lack of risk management, regardless of the type of market we're in. Those things have to be consistent for us to be stage 3 and 4. So, yeah, that's the only thing I want to add there.
Yeah. So the next one, system hopping. Again, I think this is more of an issue for stage one and maybe early stage two traders. It's before they kind of set for themselves, this is my style, this is what I'm going to do. And the first step to do this is just, again, pick a trader or pick a system, pick a methodology that makes intuitive sense to you. I interviewed a lot of traders, and William O'Neill's work was the first one that really just kind of made sense for them. And they might not trade exactly like O'Neill now, but that's kind of their foundation that they built everything upon, and they of course made tweaks to make it more suitable for them. But identify a single system that makes intuitive sense, pick that one and just say, all right, I'm going to get my PhD in swing trading pullback setups. That's my focus, and it should match kind of your style, your personality, your time constraints as well. Many of you are probably working full time and might not be able to day trade all day, or even really actively swing trade, or maybe you can only watch the close, so you have to adapt a strategy that works. A lot of position management at the close. Just pick something that works for you and stick to that so you can become a specialist in it. And again, it's just important to recognize that not all styles work well all the time. There's going to be, again, 2 to 3 periods a year where, really the methodology that we use is really excels. And recognize, again, that specialists get paid in the markets. You only need one style to become incredibly wealthy at this. Focus is much more effective than trying everything out at once. This is true in trading. This is true in business. All of this. Commit to a style, one setup, and work towards mastery. I think that's the biggest takeaway we can give you guys. And if you are system hopping, just make a contract with yourself for 3 months, for 6 months, whatever it is. I'm only going to trade this way, and I'm going to ignore, trying to trade shares, trying to trade options, trying to trade futures. It's not just styles; it's instruments as well. I've been talking to a lot of Trade Lab members over the past few weeks and months, and a fair number of them, a big issue they're dealing with is they're trying to focus on mastering options while also swinging shares, while also investing in ETFs and managing 5 accounts at once. Focus on one system and one process makes it a lot easier to improve at that skill and improve at that system. Ryan, I think you've probably got some good thoughts on this. Anything you want to add?
Yeah, I think it's, system hopping is essentially randomness, and randomness is a barrier to your success. So, a few good examples of this would be, even myself in the early days, I tried everything and I kind of learned my lessons that way. And it got me to be successful only 8 to 10 years later, right? Whereas if I actually sat and focused on one thing, not trying to trade derivatives of oil or Forex or trying to look at the market from a news perspective, if I did one of those, and only did that for a long span of time, I would have gotten to where I wanted to be a lot quicker. So it's just a lesson that many traders, even market wizards or folks that build their own systems or cycles, they stick within that system and cycle that they've built, and they continue to refine that one thing in an iterative way over the years, right? One example is Stan Weinstein, the book that he wrote over 25 years ago now. He's refined that same system. The core of it's still the same, but he feels the market's now moving a lot faster. He's looking at the daily charts more. He's looking at the 50-day more, right? He didn't go, okay, I have this system now, I have to start over to go try some other thing. He still sticks to stage analysis, he just adapts it. He adapted it to the current market, and he didn't system hop from one thing to another. He's been doing the same thing for 30 plus years now, right? And he's mastered that. His feel for the market, his feel for tape reading, what he sees and the observations that he's making are so consistent. Even though some folks might say, "Oh, that it's not the perfect system," or whatever the case might be, but it's allowed him to be profitable for over 3 decades now, right? So um, that's a lesson in and of itself. Uh, the biggest, most successful traders are refining what they have as a system instead of completely scrapping things every few years or every few months and going to something new. So
Yep. Oversizing. Again, I think this is an issue for stage one. They hear an idea on Twitter and they just like, all right, this is my path, my ticket to success. I'm gonna go all in or put most of my account in it. Um, that's just kind of over time, again, over time, over a series of trades, a recipe to have a really large drawdown and probably quit trading and stop trading because you just don't have the capital. So I think some practical things you can do: outline the max position size and max risk you can take on a position, and determine really clearly for yourself in your rules how you determine position sizes for new trades. And if a trade that you come up with, you calculate where your stop loss would be, what your position size, and it's outside of your parameters. You just simply can't take that trade or take that trade with that size. Remember, the goal is to trade for decades. We don't need to make our fortune all at once. Remember, then when we feel the need to force things in the market, I need to force myself into this position. It's likely the wrong way to go, and there'll be a better opportunity in the future. And I said this earlier, like weightlifting, you must earn the right to increase position sizes. You have to build that up over time. Once you're kind of in stage two, stage three, then you can start saying, all right, I'm going to slowly increase my max position size I can take. I'm going to increase my risk slightly in the best environments. Another practical thing that you can do is track your total open risk. And we actually show you guys exactly the math in the Trader's Handbook. It's basically just determining what is the max loss you'll experience if all your stop losses on all your positions currently gets hit. And if you track this number and realize where we are in the market cycle and what that number should be, depending on where we are in the market cycle, it can really protect you when the tides turn and we enter a new correction and prevent you from kind of oversizing, over trading at the wrong moments, at the wrong times of the market cycle. Ryan, anything you want to add on oversizing positions, sizing too much?
I think what you said with weightlifting is key. You have to have reps to build size, and you can't just pick up a 100-pound dumbbell and start trying to do something with it. So there's progression to it. Every time you see someone else size heavily, it's because they're confident or they're irrational. But you have to be rational about your approach in the markets. You have to be risk adverse. You have to come to terms that this is not a lottery ticket that you're buying. And it's going to take multiple trades over a span of years for you to see that equity curve rise steadily, right? And over time, if you survive, you'll also have luck and you'll catch ginormous gap ups, which will boost your confidence, or maybe even make you overconfident sometimes. But it will allow you to stay in the game, right? And wrong or incorrect oversizing or social oversizing when you're looking at someone else and you want to mimic them, doesn't work, because there's emotion involved. There is um, decision making involved that you're not ready for, or you may not be ready for just yet. So, if you're at 6 to 7% position size, take that to 8 to 10 and see how you respond to it emotionally. If you respond to it well and you're still making the same decisions and you're consistent, then the next step is 10 to 12, right? And then you step towards um, that size of 25%. A lot of traders and me and Richard, when we do these webinars, we always get the question, how do you position size? How much are you position sizing? I want to copy what you're doing. I can position size at times as much as, 40% in a single name. But I don't think another trader, if I say 40% and they do 40%, I will manage it much better because I just have built it, right? I can sit here and really, even if it goes against me, I can sit here and stomach that. Whereas trader B might even not even know what to do, right? So Richard, like for you, as you started, maybe,
Yeah.
you didn't start at heavy size. You probably started at 4 or 5%, 6, 7%, 8, 9%. Then you worked your way up to it. So that's the biggest lesson here. You can't copy position sizing. You have to, you know,
Yeah.
go through the reps to build it. So
When I started, from what I learned through Dr. Wish, I started with about 10 positions in a portfolio, 8 to 10% in it. But over time, as I talked to more traders and built my confidence, built my system, used smaller stop losses, now kind of my goal is to split my portfolio into 5 slots of about 20% each. And I might size one name a little bit higher, a little bit lower, go on margin two. But my desired position size in a leader, I want to get about 25% in, the leader, the top three names. But again, I'm managing my risk as I do that, and I understand when to do that, what markets part of the market cycle to do that, how to set my stop loss, where to set my stop loss, all that stuff. So I think oversizing comes from seeking performance too early in your trading career, where stage one, stage two, and even the first half of stage three, it's really should be a focus on process over performance, building the habits, building the technique, so you're able to handle this, increased sizes and all that. So I think this is really important. And if you're someone who oversizes, just be honest with yourself where you are in your journey, and if you have the right to do that based on objectively, is this the path to my success over time?
and
Another,
and
yeah, go ahead.
just one more thing, when we said what stage are you in, and most said stage 1, 2, 3, and if your position size is likely 20% or more, you will likely struggle, and there's a high correlation there. As a stage one trader, if you're likely placing, you likely don't even know the number or the percentage, right? That's the first thing that you want to do in stage one. Stage two, you likely know the number and the percentage, and it's likely too heavy because you're big losses and big wins, right? That means big position sizes both ways. Um, Stage three is where you try to figure it out. Maybe you get closer to that 10 to 15% mark. And then after, when you're in stage four, then it's about maximizing, right? So then 15% or higher, your built emotions, etc. So maybe we'll actually make an update to that diagram that we have and really write out, recommend. I think we will be doing that in future webinars. So
Yeah, and the other thing I want to add is if you're stage one and early stage two, there's no there's no reason to force things in a way, or there's no
shame.
what yeah, there's no shame in trading a much smaller amount of capital
Yeah.
that you have at your disposal, right? If you have 100K that you can trade, whether it's a margin account you built up or a Roth IRA or whatever, when you're building your process in stage one and stage two, you know trade 1K of that. Trade something where you feel losses, but if you lose that account completely or experience a 50% drawdown, you're not setting yourself back financially because again, it's about process over performance first of all. And then as you prove to yourself that you can perform, then just like you're increasing your position sizes, you could increase your overall account. That's another way to reward yourself for learning trading and improving over time and all that. So again, there's no shame in trading a lot less as you're learning this. There's a reason we have training wheels on bikes before people, go on the bike pass and while kids are learning. It's because it's to protect you, and it allows you to focus more on technique, because a 5% making a 5% gain in $1,000 account is the same process as making a 5% gain in 10,000 or even 100K. As you size a lot bigger than that, it gets, some things change, but for the most part the root process is the exact same. So don't feel the need to trade to overtrade your account, your entire account, while you're still in stage 1 or stage 2. Yep. All right. Stop buying late, improving entries. This was something that I dealt with a lot the first year I was trading. And I went back and studied my trades, and that's how I realized that this was an issue for me. So again, post analysis is key for identifying a lot of these issues and identifying the root cause of them. Looking back on my trades, I realized that I would enter the right names, the right stocks, but probably 3 days too late, after the stock had already moved 5, 8, 10%. And then what's going to happen after even a leader like Tesla makes a strong move? 5, 8, 10%, there's going to be a natural pullback, natural correction. And I would just get stopped out over and over again. I was like, why is this happening? And then it just takes off without you. Probably a lot of you watching this can relate to that. And studying my trades, I realized again, I'm entering when it was already short-term extended. It already broke out through the ideal buy point. It already moved off the moving averages. And now I focus a lot more on trying to catch the first momentum move through a pivot or from an earnings gap, getting in a lot earlier because it feels riskier, but it allows you to manage risk tighter. It allows you to get that natural expansion as everybody's kind of joining the trade. So I think it's important to recognize that stocks move between expansions and contractions, uptrends, pullbacks, then new uptrends. And if the stock has already expended a lot of energy recently, it likely needs a natural pause, pullback within the uptrend, and you just kind of want to wait for that and wait for the next setup to occur. So as you're looking for trades, ask yourself if the stock is currently likely to make a large directional move from the current point in time. If not, it might not be the best time to enter because you're not going to get that natural move, from that directional move. And also ask yourself, does this stock realistically have a chance to double from here? Right. I think this is a key takeaway that I learned from you. Are we at a point in the stock's life cycle where it's setting up a base that it could easily make a 40, 50, even 100% move? If not, maybe it's not the time to be watching that stock. Maybe it's later in the move. Maybe that stock just doesn't have that potential. But either way, maybe it's not the best choice for you. Another way to phrase this is, are we early in a stage 2 uptrend? Are we late in a stage 2 uptrend? How many, bases have we had? If you're using the William O'Neill Can Slim methodology, a stage 1, stage 2 base has greater potential than a stage 4, stage 5. So buying late also, is based on the in the moment trade, but also on the larger context of the stock's life cycle as well. And then lastly, before you enter a trade, and this is important, we talked about this, ask yourself if you can place a tight and logical stop loss under support, under a moving average, whatever. And if you can't, again, you might be buying at a moment where it's already moved quite a bit recently and it just needs to set up again. So those are a few things to think about if this is an issue that you're experiencing. Ryan, anything you want to add about buying late?
Yeah.
Things you've
I
seen
I
traders
think
do? Yeah.
It's 11
one
to
one
12.
of the one of the things that like you're likely tracking too many stocks, and you are not concentrated on some of the best moves.
Right.
Is if I have 15 or 20 stocks on my focus list, that's not, you can't focus on 20 stocks at once, really, right? You could track them, you could track how they're doing, but if you place 20 stocks on your focus list, I don't know how to buy or track things, in a day, 20 things in a day, right? If we just talk about anything outside of trading. So the fewer that you track, or you feel like, okay, I tracked these 5 stocks, the sixth stock actually was my best performing. There's a learning opportunity in that, and you'll get better at stock selection over time. right? But if you track 20 stocks and you end up catching none of them, or you end up buying late in the ones that you do buy, will hurt you in the long run, right? So you want to balance, again, focus how many stocks you're looking at versus trying to do too much at once again, at the same time when it comes to trading. So I think the biggest mechanism that I see when traders say, hey, I didn't get into a PLTR at the right time before it doubled and my entries, this and that, and then I caught the stop loss and it resulted in a bad trade. All of that boils down to how do you get the best names to be the top five on your screen? And how do you concentrate on those names so that you're buying them at the right time? If you do that, and then there's a feedback loop, right? If those five, there are times where I have three names on my screen. I've been tracking them for quite a while, and when the market gets going, everything else is working and those three names don't work. That's a learning opportunity. It's a market cycle thing. It's
Yep.
okay. It happens. You can't be perfect in every cycle that comes across, right? You go back and you go back to the drawing board, you look at what happened and you tweak things and you get better, right? But if I sat there and I put 30 names, sure as hell I'm gonna, catch 10 of those 30 names are gonna move. But it's near impossible to get really nice entry areas where you can manage risk on 30 names at once. So uh,
Yeah.
shorten those focus lists. Try to go for, like Richard said, he's at five now. He used to be at 10. He's at five. He's trying to size well in the top names, and it will improve your entries, essentially. So,
Yeah, it goes back to the focus principle that we had earlier on. And right, I don't even know if you were here, but I talked about a big change in my performance and my confidence came when instead of at the open watching 15 names on my weekly focus list, my overall weekly focus list, I decided I'm going to create a daily focus list of 2 to 3 and ideally one or two. That's my focus for the day. And I'm going to get damn good execution on those trades, on those names if I do enter. So I think that's a big shift that you can make here.
that, and also I've seen traders like when they introduced, let's say, relative volume, like Dan Zanger's approach, right? He will only take a trade if it goes through a pivot and has high volume, right?
Right.
That worked for him. It allowed him to concentrate. That's all that it really did. It took a name, if he had seven names on his list, he would trade two out of those seven because the two had more volume going through a pivot than the other five, even though the other five were moving, let's say, through a pivot, right? But now he's concentrated on I want a price move with volume, right? And that became his go-to, how he made a ton of money in the markets. So,
Yep,
yep.
exactly. All right, using too many indicators. I think this is a common theme for stage one traders. I know I suffered from this. I used to like to code these dots, these indicators that I would love to code up, and they were a lot of fun to make. But at the end of the day, if you have too many indicators, there's going to be noise, and that's not going to allow you to focus on price and volume, which is the most important thing. So I think that the thing to think about is if an indicator does not help you analyze a chart for an entry or for position management, cut it, take it out of your process. It's just another signal that is confusing your brain and distracting you from what really matters. And a key exercise you could make today is start from scratch, take everything off your screen except for price and volume, and only add back layers that are really essential. Um, and even before you do that, study price action of some big winners like Nvidia last year, and just try to look at the price and volume moves, the expansion, the contraction, how stuff's creates resistance, how stuff forms support, how it acts at that support, and recognize that price action is almost all you need, and everything else is just a guide and there to kind of point out significant things that are already apparent in price and volume. And just all in all, eliminate redundant indicators because there's stuff that looks for momentum moves like MACD and RSI, all this stuff. It kind of is looking for similar things. So having two different indicators that are looking for the same general principle is just adding, again, confusion because then you might not take a trade because the MACD looks good, but the RSI is 40, not 20, whatever it is, and you'll miss that trade, or you won't, or you'll take a trade because they're lined up perfectly, but then you're entering late. So I think if you're going to use indicators, and I use a few indicators, I really focus on the ones that are very relevant to how I interpret price action and actually help me with my entries and exits. I think that's key. And what we recommend sticking closely to down here is key moving averages. I like the 21 EMA first and foremost. I know, Ryan, you've got slightly different ones that you watch, but we look to use moving averages that, based on historical analysis, help us manage winners and help us identify winners. The relative strength line, also a very important indicator, helps you determine how stuff is performing versus the market, showing relative strength, standing out in terms of a potential momentum idea. And then lastly, I use relative measure volatility, which helps me, judge contractions and expansions. So all in all, just kind of pick and really focus on the ones that are most important to you and only help your process. Rye, I'm not sure if you're still here, but if you are, anything to add on this process? And he might have had to go. He's traveling currently. All right, we'll keep on moving forward. So some general key principles and exercises to overcome trading problems that you might be experiencing. I think first and foremost, I've said this a few times, write trading rules. This weekend, if you are honest with yourself and need to update them or write your first trading rule set, go ahead and do that. It can fit on a page, just basic entry exit criteria, stock selection, risk management. That's the most important thing. So start with that. Then you can move on from there. Always update it. It's always a living document. Next, do a deep dive in the biggest winners from 2016 to 2025. Again, we have the TraderLion model books that can help you with this. But just look at the top performers each year and go through their charts, bar by bar, and you'll learn so much doing that. Then do a deep dive into a setup you want to learn. But at the end of the day, again, trading problems often come from a lack of clarity and lack of experience. And just over time, as you gain more experience, go through more market cycles, you'll get more seat time experience that allow you to interpret things differently and focus more on your process and system. So overall, just you focus on building a system, habits, setting yourself up for winning position by creating your trading system in a way that allows you to alleviate a lot of these trading problems. So hopefully that was helpful for you guys and gave you some nice practical advice. All right, so a question for you guys in the chat here. Have you written trading rules? Do they need to be updated? If not, my call to action for you guys is to start this weekend. This, again, is your contract with yourself with regards to this business, which is stock trading. You're not going to start and open a store and pay rent if you haven't figured out your business model. Likewise, you need to figure out your business model for trading so you can actually approach this in a professional way. So let's see the answers here. I see some yeses, which is great. Rules need updating. I think that probably applies to a lot of people. So that's something you could do this weekend as well. Thanks for the participation, guys. And put in the comments as well what you're kind of working on to improve your written trading rules. All right. All right. So that pretty much covers the key concepts that we had for today. And I just want to spend a little bit of time talking about this project that we've been working on that kind of has led to this webinar series that hopefully you guys you'll find extremely helpful. And basically, we, over the past year plus, have been working on a new book, the Trader's Handbook, that's its title. And we wrote it to help people create their trading systems and take it up and build it from the foundation to a point where they can become a stage 3 and stage 4 trader. It's for traders of all levels. It will apply to if you're just starting out. I think it'll be extremely helpful. And then if you're stage 3, stage 4, make the final tweaks, especially the later chapters when we get into writing trading rules, post analysis, analyzing trades, doing studies. Those final chapters will help you give that final edge, that final layer that really helps you progress and improve. So this is something we're immensely proud of. We've spent an incredible amount of time creating this resource for you, and it kind of incorporates all our 70 plus years of combined knowledge into this book and what it actually takes to build a setup, build an edge. It uses our system as an example and gives you concrete guides about how to trade like we do. But again, it goes back to the general principles. So even if you're a day trader, you'll get something out of this book that you can help improve your system. How is it structured? Each of the chapters, as we'll go through, kind of covers one aspect of a trading system. But first things first, I think our key goal with this is to help you build and refine your trading system and improve as traders. We cover edges, setups, entry tactics, risk management, sell rules, everything at a very practical level. And we also include exercises, resources, And the final chapter is a model book chapter of 200 plus charts. So again, we've talked a lot about the benefits of studying history, and we kind of created a resource within a resource to help you do just that. So definitely spend a lot of time, and this model book chart chapter itself can pay for itself, many times over. So definitely excited for you guys to see that. How it's structured, chapters 1 through 4. Here's kind of a quick summary of what they cover. Chapter 1 is an introduction. It sets the stage and introduces and covers the 5 principles we talked about today. Chapter 2 introduces the stages and gives you even more detail about how to progress, how to identify your current stage, and what to do to improve and continue on your journey. Chapter 3 is technical analysis foundation. It provides the foundation that everything else will be based upon. Goes through from reading a price bar all the way up to new opportunity zones and some different frameworks to look for different edges that we see in the markets. Chapter 4 dives even deeper into edges and setups, exactly what we look for, with a lot of examples as well. And we share our thought processes and specific ones that we exactly use. Chapter 5 gets into entry tactics and trade execution. So I saw a few people discussing that their problem wasn't the rules, it was execution. And I think this chapter will help a lot with that. And it discusses the entry tactics we use to enter positions, how we manage risk, and all of that. And that's kind of the final piece of the puzzle when it comes to combining a setup with an entry tactic to really create a strong potential for a good trade. Chapter 6 is probably the most important, especially for newer traders, risk management. It dives deep into risk management and specific things to do, both from a portfolio and individual trade level. And it also lays out a clear process for how to set position sizes, getting into even more detail based on what we talked about today. Chapter 7, sell rules of position management, how to actually manage a trade when you have a winner. Winners don't take care of themselves. I think that's a misnomer that a lot of people say. To really get the most out of a trade, you have to watch it carefully and let it do its work, but also be willing to cut it at important times, trade around a core position, and otherwise manage that position. Chapter 8, we've talked about today the importance of market cycles and recognizing where we are within one. And this one discusses how to analyze the market, where we are in a market cycle, what you should be doing at different points within a market cycle. And it's kind of a guiding light to determine how you should be trading depending on what type of market we're currently in. Chapters 9 and 12. Chapter 9 covers stock selection, routines, screening. We share many different screens that we find immensely useful and part of our core process. And we discuss general screens, specialist screens, and really get in the nitty gritty about creating a new screen for yourself with a specific purpose in mind. Chapter 10 covers post-analysis and trading rules. It discusses how to analyze a single trade, how to track your statistics. Again, as a bonus, if you sign up for the interest list, we provide a trade log for you and allow you to basically calculate your average gain, average loss. All the metrics we talk about in this chapter is going to be really helpful to you guys. And then chapter 11 is about kind of continuous improvement, finding new edges, setups, entry tactics, and doing a trading study, how to actually structure that. Think that through, because I think a lot of people do it the wrong way, and we kind of provide the framework that we use to actually gain meaningful insights from the studies that we do take on. And then finally, as I mentioned, chapter 12 is a book in and of itself. It's a full model book covering the past 10 years, the biggest market leaders, annotated charts, 200 plus of them, discussing entry points, key price and volume characteristics. And I think you guys will really get a lot out of chapter 12, especially the more experienced traders. You guys will really value this. And it's a great way to train your eyes in terms of what to look for in terms of setups, edges, and they provide a lot of examples of what we talk about earlier on in the book. So that's a brief overview of the handbook. I'll kind of pause here to answer any questions. You can actually order it on Amazon right now using this QR code. Definitely recommend doing that. We've already had hundreds of pre-orders. It's great to see many traders looking forward to this. And I think you guys will really enjoy it and find it immensely valuable. So hopefully you guys go ahead and order yours today. So let me pause if there's any questions here. Let's see here. It should be available in all countries. If it's not, please shoot us an email and we'll get that figured out as well. And it will be out on May 27th. That's the launch. But we'll be kind of creating these resources along the way, all these different webinars up until that point, and let you guys know any key news about this. And we'll probably do an audio version as well, but I'm really excited to get you guys this resource. See a lot of people saying they pre-ordered. That's awesome. Very nice. Perfect. And we'll probably do translations as well. So if there's a language that you'd like, definitely let us know as well. Okay. So with that, just want to recommend the tool that we use as our daily driver. This is what I use every single day to manage my ideas, find new ones. It's the best screener on there for growth, swing, and position traders. So definitely check us out already at dfu.com. We'll actually have a special week next week where you can do a free trial. So definitely stay tuned for that. And lastly, this is a quick summary again of the different webinars that we'll be covering. This is just the first of many. So hopefully you guys, look forward to the other ones as well. We'll really be getting into the details, as we mentioned. Today was much more high level, establishing where you are on your trader's journey and, the key steps, the high level steps to progress. And every other webinar from now on, we'll really get into the details, the setups we use, the entry points, how to set stop losses. All of that will be answered in these webinars. And again, you can pre-order the book here, which also dives into each of these as kind of a chapter from the book, as you saw. So we'll be getting even more into the details within the book itself. So with that, I'll answer a few questions here and see what you guys have for me. But thank you guys so much for attending, and hopefully you guys found this very helpful. All right, I see a lot of thank yous. Perfect. A lot of pre-orders. That's excellent to see. Thank you guys all for being here. How do you narrow your daily focus list for swing trading? That could be a webinar in and of itself, but from a very high level, I'm looking for one, the highest quality names that I deem leaders. If those are set up, I prioritize that. So if an NVIDIA, which is leading the cycle in this hypothetical, is setting up, I'm going to focus on that. But also I'm looking for the most prime setup. So that means the most mature base, the tightest price action. Ideally it had either an inside day or upside reversal day the day prior, and it feels like it's ready to make a move. And that's kind of the art in it. You got to kind of to learn that intuition about when a stock is ready to actually make an explosive move. But that's kind of how I decide what stocks go on my daily focus list from my larger lists and my overall screens, is what stock is most ready to make a large directional move, and also what is the quality of that stock. And those are the two kind of key factors that I consider to narrow it down from, say, 15 to 20 down to 2 or 3 during the trading day. All right. Yes, this is being recorded. It will be on YouTube. The good question from Cecilia: how different is the book from the 3 books behind you? I'll say it's very complementary to all of them, but it's kind of almost an application of the material and showing you how to actually put that knowledge to work, right? In them, we'll be presenting our methodology, which is updated to current times. It's an application of kind of a mixture of all those behind us, but it's kind of how we actually trade, and then also how to practically build a trading system, because these books kind of present a methodology, but don't always get into the specifics, where to set your stop loss, all of that. And we get very specific and actually give you a practical guide to how to trade and how to build a system. So it's kind of an application of these, but if you like these books, you're going to love the Trader's Handbook. It's very complimentary and builds off all the knowledge that we gained from, the giants behind us in trading, the people I've interviewed, as well as our, of course, experience over the years. So really good question, Cecilia. Fred, as long as you join the waitlist email list on our website, if you go to TraderLion.com/handbook, you'll be signed up to get all the perks and all the bonus resources. All right. Let's see here. Yeah, Glenn, we have a lot of screens in DeepView specifically designed to focus in on the leaders. We have the DeepView leaders screen, which is a more general screen, but all the leaders in all the cycles will pass through that screen based on relative strength, earnings growth, sales growth. So that's a great screen built in. We've got a lot of presets from top traders as well that they use to find potential leaders. So we have a lot of screens specifically designed to help you narrow your focus and find the best ideas of each cycle. All right. I think that's pretty much it. I don't see any too many more questions coming through. Again, we'll be covering, all this stuff in future videos. So I'm sure you guys will have questions aplenty when we cover that. But I look forward to seeing you guys in the future webinars. And if you haven't signed up to the recent webinar, again, stay tuned for emails regarding that. And you can go ahead and register for the interest list. So you'll be the first to know about new webinars, new resources, all of that by scanning this QR code and joining. So thank you guys all for spending some of your Saturday with us. We definitely appreciate it. Hopefully this was very valuable to you. And if it was, please go ahead and share it with other people. If you're watching the recording, leave a like on YouTube, subscribe if you're new to the channel, and share it with others on Twitter, share it with a friend. We would, our goal is to help as many traders as possible, and you can help us kind of fulfill that goal by sharing it with others. So thank you guys so much for being a part of this. Great questions, great feedback, and yeah, I appreciate you guys being here, and I'll see you guys in future videos. Take care. Bye.